Good afternoon, everyone. My name is Myron, Frans, Commissioner of Minnesota Management and Budget. I'm joined today by State Economist Laura Kalambokidis and Budget Director Margaret Kelly to present the February forecast. And today I'm happy to announce with our very special cover the budget forecast for today. I'm pleased to announce a budget forecast that puts Minnesota's sound fiscal management back on track. We are now forecasting a positive balance of $329 million for the 2018-2019 biennium. And also an additional $251 million positive balance is projected for the following biennium in 2020-2021. Today's forecast shows a balanced budget for this biennium and for the next. We faced a number of uncertainties in November, you will all recall. At that time, in November, at the November forecast, Congress had not passed a tax bill, and Congress had not provided funding for the Children's Health Insurance Program, or CHIP, and the funding for the Minnesota legislature had not been passed. Well, with today's forecast, we now know that the Minnesota effects of the federal tax bill, with some issues to discuss. We also now know that the CHIP has been funded for 10 years at the federal level, and we now have the legislative funding bill signed by the governor as of Monday. All of these previous uncertainties are now reflected in this forecast, and in addition, we have included our projections of future economic growth. The budget forecast reveals the $188 million deficit from November has been replaced with a $329 million surplus. You can see that the revenues are growing by $353 million and expenditures are decreasing by $167 million. Now that's a net decrease, and Budget Director Kelly will describe that in more detail. The expenditures for fiscal year 2018-2019 now include the bill signed, as I said, on Monday by the governor for the legislative funding for this biennium. The total change, as you can see from the November forecast, is $518 million, or a $500 million improvement from what we saw in November. So I will now bring up Dr. Kalambokidis to explain the economic forecast.
Thank you, Commissioner. So I will start by talking a bit about the outlook for the U.S. economy and how that outlook has changed since we last prepared a forecast in November. I will then move to Minnesota's economy and finally the changes in our revenue forecast. So the first chart compares the current U.S. real GDP forecast by Minnesota's macroeconomic consulting firm, IHS, to their prior forecast. So the dark bars show IHS's February 2018 outlook, the one that informs our forecast today, and the light bars show their November 17 outlook. The chart shows that the outlook for U.S. economic growth has improved since the November forecast. The U.S. economic data coming in this winter has been solid. Consumer spending and business equipment investment have been strong, and consistent growth in other major economies has strengthened demand for U.S. exports. In addition to the improvements in initial conditions, earlier this year, IHS incorporated into their baseline outlook stimulus from the Federal Tax Cuts and Jobs Act, the TCJA. That was not in their November forecast, so that is a change from the November forecast to now. The addition of the TCJA has modestly improved the near-term U.S. economic outlook. It has also sped up expected price and interest rate increases and significantly raised the forecast for federal deficits. In IHS's February outlook, consumer spending and business investment both contribute more to 2018-19 real GDP growth relative to November, and both of those things, consumer spending and business investment, are incentivized by the TCJA. IHS has increased their forecast for real GDP growth in 2018 to 2.7% from 2.5% in the November outlook. Real GDP is forecast to maintain that 2.7% growth in 2019 before dropping to 2.1% in 2020 and 1.9% in 2021. That deceleration from 2.7 to 2.1% is due to slower growth in both consumer spending and business investment, the things that were incentivized by the TCJA, as the impacts of the TCJA are offset by more aggressive monetary policy. The next chart shows growth in total U.S. real consumer spending. So one of the things that was responsible for the increased economic outlook. IHS expects consumer spending to remain the primary contributor to growth in the economy, even as the pace of spending eventually slows. In the short term, consumer spending is well supported by rising employment, disposable income, rising household wealth, with an additional temporary boost from lower tax rates from the TCJA. In this forecast, real consumer spending is expected to grow 2.9% in 2018 compared to the 2.5% projected in November. And that improved forecast continues into 2019 with projected growth at 2.4% relative to 2.2% in November. You will see the impact of this improvement on our sales tax forecast when I explain the revenue change. Past 2019, however, IHS does not expect consumers to keep up the pace. They forecast a slowdown in real consumer spending in the years of our planning estimates. Spending growth is forecast to decelerate, slow down, from 2.4% in 2019 to 2.1% in 20 and 21. And this occurs because IHS expects consumers to shift their focus from spending to saving. Turning now to Minnesota's economy, the first chart about Minnesota's economy shows the headline unemployment rate. So the headline unemployment rate over time, the broad unemployment rate over time. The dark line is for Minnesota and the light line is for the United States. And as usual, the vertical gray bars indicate the US recessions. So the white space between the bars represents the recovery and expansion periods. With the US expansion in the second half of its 9th year, which is a mature expansion, Minnesota's steady economic performance and tight labor market continue. The state is currently adding jobs at the same rate as the nation, even as available workers become scarce. And that steady job growth has kept the unemployment rate low. Minnesota's unemployment rate currently stands between the low points of the prior two expansions at 3.1%, nearly 1 point below last year, and a full point below the US rate, and the lowest we've seen in about 17 years. The next chart illustrates Minnesota's tight labor market. The gray bars show the number of unemployed people in the state, and so this is the number of people associated with the unemployment rate you saw in the prior chart, and so it's people who are both unemployed and looking for work, actively looking for work. So the height of the gray bars shows the number of unemployed people in the state, and the dark bars show the number of job vacancies statewide. So in the height of the gray bars, you can see the peak of the recession or the depth of the recession. And then you can see that steady job growth that I talked about. Minnesota's had steady job growth through the expansion. That steady job growth whittling that number down. The dark bars, again, show job vacancies. And as you can see from the final data points on the right, that job vacancy number has reached a very high level. And then the relationship between the two, the ratio of the number of unemployed job seekers statewide to the number of job vacancies statewide, so the relationship between the gray and the dark bar in each time period, that ratio has hovered around 1.1, 1.2 for the last 3 years. But it is now below 1. It's 0.9. So that means, so you can see the dark bar rises slightly above the gray bar. That means that there are now slightly fewer unemployed job seekers than open positions across the state. Together, high demand for labor and low unemployment have supported growth in Minnesota wage and salary income. Over the last 12 months, average hourly wages by private sector employees in Minnesota have been growing faster than the comparable rate for US workers. The large number of open positions, so the large number of vacancies in this chart, that large number of open positions improves prospects for job seekers around the state. And better prospects may have contributed to a gradual increase in Minnesota's labor force participation rate, which has ticked up to 70.6%. That's 1.3 percentage points higher than a year ago. It's the second highest among US states, and it's nearly 8 percentage points above the national rate. And the increase is notable because Minnesota already had one of the highest participation rates among states, and it was already well above the US rate, and it's occurring as the large baby boomer cohort is retiring. So these changes in the economic forecast have helped bring up our forecast for tax revenues. So that's the next slide. Total general fund revenues, as you heard from the Commissioner, for the current biennium are now forecast to be $353 million more than the November forecast. Higher expected individual sales, individual income tax, sales, corporate tax, and other tax revenue all contribute to the change. So all of the major tax categories have a higher forecast now than they had in November. In addition to the improvements in the near-term economic outlook that I've already explained, this forecast reflects increased state income and corporate tax revenues expected to arise from taxpayer responses to the federal tax law changes in the TCJA. So this was a big and complicated tax law change at the federal level, and as individual and business taxpayers are trying to figure out how the new tax law affects them, they're adjusting to these changes, and they're adjusting their fares, making various choices. And some of those the choices they make will automatically affect Minnesota tax revenue under Minnesota's current law. So that's even without any legislative action, so without conformity. So these are changes that people are making in response to the federal tax law, and not just individuals, but corporations too, and I'll talk about that in a moment. And we've included a net positive change to the revenue forecast for those changes. So those estimates are included in this forecast. The largest dollar amount change in the revenue forecast is in the corporate income tax, which is forecast to generate $131 million more in FY 18-19 than we had estimated in November. The three things that have moved the corporate income tax forecast are that we have larger than expected corporate receipts so far in this fiscal year, so that raises the base for the forecast. The corporate profits forecast from IHS is a little bit higher than it was in November. And this change reflects increased state corporate tax revenues expected to arise from corporations responding to the TCJA. Specifically, the repatriation provisions in the new federal law, so corporations under the new federal law have to deem all of their foreign source income as repatriated to the United States and pay tax on it. So that deemed repatriation provision should induce firms to actually repatriate some of that foreign source income. So not just deemed repatriated, but actually bring it back. And if they do, to the extent that they do that, Minnesota will pick up some tax revenue for that. And so we have an increase in the corporate tax revenue forecast for those actual repatriations. There is a related addition to the individual income tax that's related to those repatriations that I'll explain in a moment. Consistent with the improved outlook for consumer spending that I showed you in the bar charts, the sales tax revenue forecast is also up. Sales tax revenue in FY 18-19 is now forecast to be $119 million more than the November forecast. This is due to a higher forecast for taxable sales in both 2018 and 2019. So we don't tax everything that is shown in that consumer spending bar chart that I showed you earlier. Minnesota taxes items that are included in consumer spending and some items that are included in business spending. We construct a proxy sales tax base based on the items that Minnesota does tax, and we see how that proxy base grows over time, and that's how we construct our sales tax forecast. So that proxy base is expected to grow 1.1 percentage points faster in 2018 and 1.6 percentage points faster in 2019 than we had assumed in November. Moving to individual income tax receipts, this forecast in the current biennium is now up $25 million relative to what we had in November. This relatively small change is the sum of offsetting effects. So some changes that were made raised the forecast relative to November, and some of them lowered it. So that's why the number looks smaller than some might expect. It's one of the reasons. For example, we now know that tax liability for tax year 2016, the base year of our forecast, so we start with a base year and grow from there. The tax liability for 2016 we now know is lower than what we had estimated in November. So that brings down the income tax forecast overall. We also had in the first 3 quarters of 2017 low estimated tax payments, which are prepayments taxpayers make on current liability, and it's generally taxpayers who have non-wage income. So having lower than expected estimated payments for that period means that our forecast for non-wage income capital gains, dividends, business income, that those kinds of things were too high. And so we've lowered our forecast for some forms of non-wage income, and that brought the forecast down relative to what it would have been. On the other hand, looking at some of the changes that moved things in the other direction, taxpayer responses to the TCJA are estimated to raise individual income tax revenue on net relative to our November forecast. For example, those corporations who have to deem repatriated all of their foreign source income, once they have that income repatriated and they pay tax on it, they can do what they want with it. And we expect that a large portion of the money that is repatriated under the TCJA will be paid out in additional dividends and stock buybacks. And so that additional financial income, some of that is going to flow through to Minnesota taxpayers, and it's going to flow through to our individual income tax. So increased financial income for some of those taxpayers raises the forecast for the individual income tax. Let me conclude by drawing your attention, and let me be clear that that's what I meant by that's the other side of the corporate change. So on the corporate side, we directly raised revenue because of the actual repatriations. On the individual side, we indirectly have an impact because some of that foreign source income that is deemed repatriated gets paid to individuals. So let me turn to my final slide, and I'll conclude by drawing your attention to some of the risks in this forecast. First, the TCJA made some big changes to federal tax law, and individuals and business owners are still figuring out how that new law affects them. Uncertainty remains about how people will respond to the changes and the impacts on both the economy and on state tax revenues. And again, those changes that we've incorporated here are before any changes to Minnesota current law. In this forecast, inflation is projected to gradually rise from what have been in the past very low rates, in the recent past, very low rates, and the Fed is expected to continue to move interest rates higher. However, employing fiscal stimulus, such as the tax cuts in the TCJA and the proposed $300 billion additional federal spending in the federal budget agreement, this late in the business cycle, when the U.S. labor market is near full employment or possibly at full employment, could cause prices to accelerate more quickly and the Fed to act more aggressively than is assumed in this forecast. So some Fed action is included in this forecast, but if prices rise faster than what's expected in this forecast, then interest rates are likely to rise faster as well, and the economy will slow down. So those actions could cause the economy to grow more slowly than is assumed here. The current environment of consistent global growth, where no major economy is currently in a recession, is welcome for Minnesota's exporting sectors, including agriculture, mining, and manufacturing. But geopolitical events and possible U.S. trade policy changes, including changes to NAFTA and to other trade treaties, could threaten that climate and reduce overseas demand for the state's products. Finally, with 16 months remaining in FY 18-19, we've seen less than 30% of the total revenues we've forecast for this biennium. Even small changes to assumed growth rates in particularly volatile income sources, such as capital gains and corporate profits, could materially alter the budget picture for this biennium and the next. I'll now turn it over to Budget Director Kelly.
Thank you, Dr. Kalambokidis. I'm going to walk through the expenditure changes in this forecast for this biennium and then talk about structural balance over the forecast time horizon. If you look on the table here, you see in the lower right that overall spending is lowered in the current biennium compared to the previous forecast by $167 million. There are four main changes to discuss in this expenditure forecast. The first change is education spending. Overall, it's down by $54 million from our November forecast, which is just a 0.3% change on a $19 billion budget. So last forecast, we saw spending on special education services by school districts. We saw that it had been increasing at a faster rate than we had expected, and we adjusted our forecast upward. We now know that actual spending for the academic year 2016-17 is a little bit lower than we had thought, and we are now adjusting our forecast accordingly. So we have lowered our expenditures on special education downward, and that's most of what the $54 million savings in education is from. The second main change is the Children's Health Insurance Program, or CHIP, in the Health and Human Services line on the table here. You see that Health and Human Services spending is lowered by $254 million compared to last forecast. That's about a 2% change on a $14 billion budget. So absent a federal appropriation for the program last November, we assumed the cost for CHIP would fall 100% on the state budget, and we added $178 million of increased spending to our forecast. We now know that CHIP is funded through 2027, and our allotment for the current biennium is higher than earlier estimates as well. So $225 million of the Health and Human Services savings is due to federal appropriations for CHIP. The third big major change in this forecast is on the all other line of spending. On Monday, the governor signed into law the legislative appropriations bill, adding $114 million of spending in the current biennium. That increase in spending offsets the savings that everyone was anticipating in this forecast. The fourth major change is also in the all other line of spending. When the budget was adopted last session, we shifted $22 million of spending that had traditionally been out of the general fund onto the Clean Water Fund. And we enacted a provision that if there was a positive balance in a forecast, we would move general fund money into the Clean Water Fund behind it. And so that provision is triggered with this forecast. Now that we have a positive balance, we have enacted that transfer into law, effectuated that transfer, and increased spending by $22 million as well. So if we move on to the next slide, looking ahead to the 2021 biennium, this table here speaks to our structural balance. It compares the revenues collected within the biennium to the current law spending obligations in the same biennium. Last November, we were projecting a negative balance out into the future, and with this forecast, we now have positive structural balance in the 2021 biennium. We have average annual growth in revenues of 3.7% compared to 2.2% for expenditures. And a note there on this table, just a reminder that inflation is not in the spending forecast, but it does put pressure on our budget, and the estimates for inflation are higher in this forecast, rising to 2.8%. And with that, I will turn it back to Commissioner Frans.
Thank you, Budget Director Kelly. Well, let me just make a few comments and we'll open it up for questions. As you know, we're in the final year of the Governor Dayton's administration, and we share the governor's goal of delivering a balanced budget to whomever assumes the title of governor next year. The principles of sound fiscal management have guided Governor Dayton's time in office, and in order for us to deliver a balanced budget to the next administration, we must be prudent during this legislative session. While a $329 million surplus is not a small figure, in actuality, it comprises less than 1% of the state's total budget. And the balance on the bottom line for 2020 and 2021 is even smaller. I know a question will be asked today about how much money we need to leave on the bottom line after this session. The truth is there's no magic number. I will say it's important to keep track of each proposal's impact both on this biennium and the next biennium. Spending and revenue changes, as we have seen, can grow over time, and our projections for the next 2 to 4 years in the future are always subject to changes. I would say that our current forecast for the 2020 biennium does not provide much of a buffer against future forecast changes. This chart demonstrates that we have a balanced budget for 2021, and we see revenues growing faster than expenditures, but it also shows the inflation pressures that we will experience in the future. As the state's chief financial officer, I want to ensure the stability of state finances now and into the future. The fact is, Minnesota's economy is in a great place. We are fortunate to be home to such a talented workforce, a diverse economy, and a business community that invests back into our great state. As a result, Minnesota has low unemployment and a growing economy. We are also in one of the longest economic expansions in U.S. history, however, and that's something we need to take very seriously. With this forecast, Minnesota's budget is back on track. We should not take a positive balance for granted, though. We must proceed with caution, and we must work together to ensure that the next administration does not inherit the same $6 billion deficit that Governor Dayton faced in January of 2011. So we must continue our commitment to sound fiscal management. And with that, I'll open it up for questions.
It sounded like in your closing comments there that you're kind of warning lawmakers not to spend this.
Yes. You know, it's always a delicate balance. In particular, this is always a unique situation where we're in the 1 year left to go in the biennium. So if we spend money for fiscal year 2019 for a program, you have to remember you have to double that for 20 and 21 generally, or sometimes even more than that. So the key really, I think, is for us to really focus on what are those things in this session that we really have to get done and we have the resources to do. I mean, I have my pet list, and the governor will come out a little bit later on and tell you what some of his priorities are. He will be looking over this budget forecast. We went through it with him this morning. And over the next several weeks, he will be putting together his response, both in terms of a tax conformity bill package and also a budget package to recommend what we should invest in during the next session. So that'll come out in mid-March. But it's always a delicate balance. And you know, there's always a desire, certainly for me, I'd like to see the budget reserve filled all the way up. We're at $1.6 billion right now. We have a target of $2 billion. As some of you know, every November we put 33% of any forecast balance into that reserve, so that if we have a balance in November, that will help with that. But there obviously are needs, and I think that is the difficult balance that the governor and the legislature have to work out. What are those specific needs that rise to the level of investing the resources, the modest resources we have? So it is a challenge, and I will always be cautious when it comes to spending money.
Is that a recipe for one-time spending versus any ongoing commitments?
Well, that's a great question. We faced that several years ago where we had a biennium in the future that had less money than the current biennium. And many of you will remember that was a big discussion about one-time money. So we will be talking about one-time spending. But for example, you know, there's $251 million now as a positive balance we project for 2021. Well, if you just project $125 million of spending now and then doubling that in 20 and 21, that pretty much takes care of all of it. That leaves like a little over $200 million. Well, how much of that should we leave on the bottom line, and how much of that should be one-time spending? So those kind of questions about, you know, looking to 20 and 21, what kind of balance can we leave, what kind of one-time spending can we do, I think are critical components that this legislature and the governor are going to have to wrestle with.
Could you comment a bit more about the gap between the inflationary projection for 2021 and the structural balance that it shows? This potentially, if we were still forecasting the way we used to, would be showing a deficit and a pretty good sized one in 2021. Because we don't count inflation on the spending side, it's showing something positive. But how should legislators understand that situation?
Well, the budget spending forecast carries about 25% of the spending forecast has forecasted inflation in it, but the rest of it does not, about 75%. So I think in addition to the fact that we have a modest balance for 2021, we have to take into the fact that for every dollar you spend, there's a couple dollars out there of inflation that are going to try to influence that. So I think they need to be very mindful, not only of leaving a balance for the next administration, leaving some money for the reserve to build up, but also making sure that we don't put such inflationary pressures on agencies, because we're going to see inflation is growing a little bit faster than it has in the past. So these inflationary pressures are real.
So the Republican leadership is saying that this is all about the tax cuts. The tax cuts work. Are they right?
Well, I'm going to have Dr. Kalambokidis come up in just a moment and explain how she factored that into her forecast. But I think the key is at the federal level, you have to remember that you can create tax cuts with deficit spending. So remember, the tax bill at the federal level costs $1.5 trillion in additional debt. And so there is a short-term benefit. The near-term benefit does create some stimulus, what Dr. Kalambokidis calls near-term stimulus. So I think the key is that at the federal level, you can do that. But at the state level, we just don't have that flexibility, because if we want to cut taxes, we either have to if we want to cut taxes for one group to stimulate the economy, we have to raise it for somebody else or cut spending. And both cutting spending and raising taxes on other groups also have effects on the economic recovery. So this whole issue about the federal tax stimulus is really focused at the national level. We've got those numbers from IHS, our consultants, to explain how this is going to affect the national economy. But we have to step back and look at Minnesota from a different perspective with a balanced budget requirement.
Speaking of that, how much of the changes are really due to federal policy, like funding CHIP and the tax bill, versus state changes?
Well, that's a good question. As we mentioned last November, we were wondering about CHIP. That question was answered, and it turns out it was a pretty big shift. We were wondering about the tax bill, and that's had some major impacts. So there are some major impacts from the short-term major impacts from the federal tax bill, but there are also some economic increases that Dr. Kalambokidis talked about as well. So it's a combination of both.
One of the big topics for this legislature is both tax conformity and protecting taxpayers from expected tax increases if, strict conformity is followed. What risk do you see in that to a structural balance both in this biennium and the following?
Well, the other thing that the governor will, as I think I mentioned, will come out with a tax conformity bill. It's a really complicated issue this year. I mean, I think for the people like me who were around in 1986, that Tax Reform Act was a little bit different. It took longer to develop. It was more of a tax reform measure, and that's when we started conforming Minnesota taxes to the federal tax. It was in 1986 after that. In 87. So this particular tax bill is extremely complicated. As Dr. Kalambokidis mentioned, many taxpayers, businesses, and individuals are still trying to figure out what are they going to do. So from our point of view, I mean, the governor will be looking at this tax conformity for Minnesota from a couple different perspectives. One of those is if we do nothing, if we do absolutely nothing in Minnesota, we are all going to collectively have more to do to fill out our taxes in 2019 because remember, our tax return in Minnesota starts on line 43 of the federal return. We accept federal taxable income as the beginning point. Well, there are 43 lines that happen before you get to that point, and we would have to have some sort of way to walk taxpayers from that through those 43 lines to get to the new federal taxable income, because if we don't conform, there'll be a lot of changes that we'll have to make. Well, that would be extremely complicated, and it will take a lot of time. So doing nothing causes complications. It does generally raise revenue for the state of Minnesota, because as you remember, at the federal level, the general philosophy was to broaden the tax base and reduce the rates. So what happens when it flows through to Minnesota is the tax base has been broadened, but the rates haven't been lowered if there's no change in Minnesota. So the idea of doing nothing would be difficult for taxpayers, but it would bring in more revenue for the state. And the idea of full conformity also perhaps costs the state in the sense that it would cause a lot of people to pay taxes differently than they would with a thoughtful conformity piece. I think the governor wants to take a look at ways to make sure that the Minnesota tax system remains really fair to the middle and lower income people, and also is fair, across the state. So it is one of the most difficult challenges I think the legislature and the governor have to do this session, is come together on a tax conformity bill that makes sense for Minnesota and also makes sense for our budget. You can see that if we want to spend on other items beyond the money here, that you're going to have to generate some money from some other source.
We've seen a variety of numbers concerning how much full conformity, if we were to go with that option, how much additional revenue that would cost the state. What is the latest number that you can share with us about that?
Do you have that? I don't know if I have that. We'll get that. I'm sorry, I don't have the exact number. What you're saying, what full conformity brings?
That brings in additional revenue above and beyond what we see through the things.
I don't have that with me right now, but it's a lot of money.
Commissioner, if I may follow up on Kevin's question directed to Dr. Kaye about Republicans' claims that their tax cuts last year here in this state are responsible for the surplus that we're having now.
Yes, and Dr. Kalambokidis.
Can you restate your question?
Yeah, Republican leadership is already saying that their tax cuts that were passed here last year are responsible for the surplus that we're seeing now. As the economist, what's your take on that?
So the impact on revenues of the economic forecast has been fed through the individual income tax and the corporate and sales tax, as you saw. And I can't identify any particular impact from Minnesota's tax action. I can say that due to the changed U.S. forecast, that we changed our forecast for wages, and as you saw, the most straightforward way to look at it is with consumer spending. And so those are the things that affected the forecast, and then we had the additional increases from taxpayer behavior changes due to the federal tax cuts.
Are you saying you can't see any state tax cut impact, or you don't know what it is?
I'm saying I can't separately identify any impact, that impact from everything else that's going on in the economy.
Can you tell us what the forecast of the drop in consumer spending is based on in the out years? It looks like you show consumer spending trending downward.
Yeah, so the question is about the economic forecast for U.S. real consumer spending that is higher in relative to the November forecast in both 18 and 19, but then it decelerates and it goes down to a lower growth rate. So it's not a fall in spending, it's lower growth in spending, or slower growth in spending. And that's because, you know, throughout this economic expansion, the consumers have been the champion of this expansion. Consumers have been responsible for most of the growth in GDP. And IHS is anticipating that consumers are just not going to keep up that pace, and that they are going to, instead, they're going to start saving some of those tax cuts that they're getting rather than spending all of those tax cuts. And so it's a change in saving behavior.
What impact would the what impact would have if NAFTA would go away, for instance? Is that a major impact on the state economy?
So the question is about NAFTA and U.S. trade policy. So the U.S. trade policy has important impacts, particularly NAFTA, for Minnesota, because our primary customers are Canada and Mexico. And so the farmers in Minnesota are looking to what's happening there. The manufacturers in Minnesota are looking to what's happening there. And so that is a risk in our forecast, is that if trade policy significantly changes in a way that it reduces demand for Minnesota exported goods, then that would be, that's a downside risk for Minnesota.
Do you have a dollar figure? Is it going to be $100 million impact, $1 billion, nothing?
No, I don't have a dollar figure for that.
Is it significant? Would you call it significant?
If significant changes to NAFTA would, including losing it, would create significant impact in Minnesota.
You mentioned the two sources of repatriated income and corporate taxes. Between both, individual and corporate taxes, what's the total net gain to the state that you're assuming in this forecast?
This is a question about the revenue impacts under current law of changes that corporations are changing behavior by corporations due to responding to the Tax Cuts and Jobs Act. In the current biennium, I believe the sum total, including the direct effect on the corporate income tax and the indirect effect on the individual income tax, was about $160 million. Positive.
Just in this biennium, correct?
That's just in this biennium. There's an additional estimate in the next biennium, but I don't have it on the tips of my fingers.
You've said, I think today, that our Minnesota economy is growing apace with the national economy. I believe it was the case that in previous forecasts, we talked about a lag in Minnesota growth and traced that to what was going on with our tightening labor market. What's changed in that regard, and what's your forecast looking forward about the impact of that tightening labor market on Minnesota's pace of economic growth?
Yeah, and so the specific pace that I mentioned where we're keeping up with the U.S. is in employment growth, so adding jobs to the economy. And you don't get to count a job as employment growth unless there's somebody in the job. So it's not just job vacancies, but it's actually putting somebody in that job. And over the last year, we've been growing about the same rate as, adding jobs about the same rate as the U.S. We have in the past expected employment growth to be limited by labor force growth, and consequently to have our employment growth be a little bit lower than the United States. But one thing that changed, and it changed in the middle of last year, was this uptick in the labor force participation rate, which it was very, as I mentioned earlier, it was very high. It was higher than the U.S. It was higher than other states. It's not high relative to Minnesota's history, but it's come down as the population has aged. But it is high relative to other states. And so I think that the tight labor market, we have in the forecast that more of our wage growth going forward, our total wage growth, is going to be due to increase in wages per worker rather than increase in employment. So total wage growth can grow if we have more people working, or if the people working are making more money per person. So going forward, more of our wage growth is going to be driven by wages per worker. So that's that tight labor market. It's tight supply, increased demand, the price should go up. and less of it due to employment growth. But our employment growth forecast is a little higher than we had in the past due to that higher participation rate.
Is that participation rate higher because of different segments? For example, older workers staying in the workforce longer? Is that what's
I don't know
responsible
the
here?
answer to that. So I don't know the changes in the participation rate by age cohort, so I don't know.
I just wanted to add, I'm sorry, we wanted to add something to the question about the tight labor force. And I'm one of those older workers staying in the workforce for a while. In terms of the tight labor market, there are a couple of issues I wanted to mention. And number one is the commitment, and this goes back to the question about how do we spend money or where do we spend resources this year, and that is in the area of education and training. Minnesota has a tradition, a history, and of having a talented and educated workforce. We're going to need that talented, educated workforce now more than ever. So as we move forward, we really need to make sure that we're putting money in all education, but certainly in the higher education and training. And that's one of the reasons I think you saw the governor's a third of his bonding bill was allocated just to higher education to make sure that those institutions have the money they need to maintain their facilities. But we need to make sure that we are doing whatever we can to ensure the success of students and workers in Minnesota to fill the jobs that we now know are out there and that are vacant. And the other thing too is from the point of view of the Minnesota State workforce. We negotiated a contract last summer after our budget bills were passed, and I think I've tried to make it clear to the legislature that we approved on those contracts. I signed off on the contracts based on our ability to fund those through our appropriations from last year. We think those are modest increases, a 2 and a 2.25% increase. In the private sector, you're seeing things much more in the 3% or more range. So we're hopeful that those labor contracts can be approved by the legislature. There's no cost to those. We've already implemented those through the budgets that we received last year. Any other questions?
Commissioner, can you tell me what the number is for debt service that you have with the new numbers on the budget, and what percentage is that based on?
The overall debt service?
Yes.
The overall debt service is, I don't have the exact number, it's a little over $1 billion per biennium for this biennium, then it grows a little bit into the next biennium. So what we're seeing now is that we're recommending, or we assume for the forecast that we have an $800 million bonding bill for this particular forecast, and that is paid for through the forecast. So if we do anything above $800 million, then we would have to add a little bit more. If we actually funded the governor's proposed $1.5 billion, it would be something between $10 and $20 million. We don't have the exact number yet, but that would add to the $1 billion biennial debt service that we have on an ongoing basis.
Is money cheap now?
Well, you know, last October, we had bond prices. We sold over $800 million in bonds, anywhere from 1.7% to 2.5%, I think was the range, and that's pretty good rates. You know, the rates are still fairly low now, but they're starting to move up. So we think, once again, this is a good time to bond because we have a good credit rating and we have an opportunity to get money that's relatively inexpensive. And really, for the long haul, it's the best way we can really enhance our asset preservation technique.
So how big?
1.5 is a good number, $1.5 billion.
This can support it?
Yes, this can support it. I mean, as I said, it's about $10 to $15 million more this biennium and less than $100 million in the next biennium. But, you know, as I say, those are scarce resources, so everything needs to be weighed against other issues too.
Can we go back to the tightening labor market? And previous forecasts had started to talk about concerns about household formations being down. Is that helping at all by the tight labor market? Are people getting better paying jobs earlier? Because it seemed as if young people were not forming households before, and that was a drag.
That's a question for Dr. Kalambokidis. Thank you.
So the question's about household formations, which means when the economy improves, people who have been living together during tough economic times separate. So the college graduates move out of the parents' basement. People who've took on a roommate during the recession, they move out, and so we get more households, and we use that in our forecast for housing demand and for a forecast for construction employment. So the Great Recession ended with disappointing levels of household formations. They did not pick up as quickly as pretty much anybody expected. There's the actual data we have on household formation still remains low. But we are forecasting that they improve in the next year and get, within a couple of years, up to what we think is a normal level. So there's this there have been these pent-up formations that we are finally putting into the forecast.
Why do you think that is still low and concerning?
I don't know exactly why the numbers are low in the most recent data. They were surprisingly low, but there are a couple of things that it could be, and this is speculation. I mean, it could be that because the population is aging, we have more people moving into cohorts that are older, and older cohorts tend not to move as much and tend not to create households as much. And so it could be a demographic thing that way. And there's also speculation that it has some things to do with the living choices or living arrangements choices of the younger generation, the generation 25 to 35, who would be the ones who would buy new houses, that they've changed their, or they have different preferences for housing relative to prior generations, possibly due to the time in the business cycle that they entered the job market. They're a little more spooked about taking those risks.
I know that had been part of the speculation that we have a generation riddled with college debt and that's slow
Again,
formations.
Again, I would say that's speculation, that's potentially part of the story too, for the lack of demand of younger people, but I don't have specific evidence saying that. It's just these are the things that are likely to be causing it.
What about the fact that there's a housing shortage and houses are more expensive, which is in this report?
Sure. But the disappointingly low household formations preceded that. And so those explanations, I think, precede that story. And so indeed, we have low inventory of houses for sale in the Twin Cities, and, tight supply should increase prices, and indeed, prices are getting higher. And so that becomes an issue of affordability.
How do you reconcile the rising price of housing with slow household formation?
Yeah, I think it's a puzzle. I think housing right now is a bit of a puzzle. So the rising prices would mean that affordability is lower, and so people might stay together longer. But what I think is the bigger puzzle is, why do we have tight supply, low numbers of houses on the market as the prices are going up? And we need to be done. Okay.
Answer more questions later, but the governor's en route, so. Let me just clarify one question. I like to answer these things in real time. So the question about the amount of money that would come into Minnesota if we did full federal conformity, this is from a preliminary estimate revised from February 16th by the Department of Revenue. It's about $460 million additional revenue in 2019, and over $1 billion in 2021 would come in if we did full conformity without making any changes at all to Minnesota tax law from a policy standpoint.
Short break here, and then the governor will be right here. Thanks,
Thank you
everybody.
all very much.